A rough week for the banking industry.
The collapse of Silicon Valley Bank.
The second biggest bank collapse in U.S. history.
Imagine waking up one day to find that the bank that held your startup's funding, the bank that was supposed to be your partner in success, has suddenly collapsed. That's exactly what happened to thousands of Silicon Valley entrepreneurs this month when Silicon Valley Bank went bankrupt, leaving a trail of devastation in its wake. But what led to this once revered institution's downfall? What caused this bank failure, which is estimated to be the second largest in US history? Stay tuned to find out the answers and the shocking truth behind the collapse of Silicon Valley Bank. Silicon Valley Bank was known for its innovative approach to banking. They catered to technology companies and venture capital-backed startups, providing them with much-needed capital to fuel their growth. The bank grew rapidly, becoming one of the largest in America, with billions of dollars in assets and deposits. As the bank grew in size, it sought to increase its profits by investing in long-term bonds when interest rates were near zero. The bank continued to invest in these bonds despite the warning signs of their increasing risk, with the belief that interest rates would remain low for the foreseeable future. However, when interest rates eventually rose, the value of these long-term bonds plummeted, resulting in a significant loss of $1.8 billion for the bank. This loss led to a rapid decline in the bank's value, losing over $160 billion in just 24 hours. That is when their clients started freaking out and withdrawing their money at a crazy rate. But here's the kicker. The bank had most of its funds invested in those crappy long-term bonds that were now worth nothing. And obviously, the bank was totally unprepared for such a massive withdrawal. Want to know what happened next? Before I tell you, take a minute to subscribe to my channel, as I frequently upload shocking videos on recent events in the world of business. I know you don't want to miss out. And while you're at it, give this video a big thumbs up. Okay, let's get back to our video. So, things got real ugly when the panicked customers of Silicon Valley Bank started pulling out their cash. They were like, "We want our money now!" But the bank did not have enough cash to cover their withdrawals, and it was getting worse by the minute. The government had to step in and take over the bank so that customers could get their money. Can you believe that? A bank that was trusted by tech workers and venture capitalists went belly up. And to make things worse, even the CEO had sold a ton of company stock just weeks before the whole thing went down. This led the people to believe that he knew something was up, but kept it a secret while others lost their hard-earned money. Luckily, the government was able to step in and prevent a complete disaster. The FDIC was able to help out the depositors in the end. They were able to access their funds and get their money back. Still, it is going to take a while for everyone to recover from this disaster. Regulators and investors are going to be on high alert, making sure that nothing like this happens again. And why wouldn't they be? It was the biggest failure in the US banking world after the 2008 financial crisis. They want to make sure nothing of this sort happens again that can leave the economy in shambles. This whole mess served as a warning to everyone in the finance game, and to you too if you are watching this video. Don't go overboard and take on too much risk. Diversify your investments, people. The bank's failure was a stark reminder that being reckless can have disastrous consequences. Do you think Silicon Valley Bank's collapse was avoidable? Or was it just a matter of time before their risky investments caught up with them? Let me know your thoughts in the comments below. Thank you for watching. We'll see you next time.